IAS-16 property, plant and equipment is a long and very important standard in accounting. To make it easy to understand this long standard in a short time, let us first focus on the breakup of IAS-16 property, plant and equipment. There are 3 steps to memorize this long standard: definitions, initial recognition, and finally subsequent measurement. Let's come to the definitions one by one. First, property, plant, equipment. These are tangible assets with the following properties. They are held by an entity for use in the production or supply of goods or services, for rental to others, or for administrative purposes, and they are expected to be used during more than one period. Some examples are cars, building, furniture, machinery, etc. Then comes the cost, is the amount of cash or cash equivalents paid or the fair value of the other consideration given to acquire an asset at the time of its acquisition or construction. Residual value is the estimated amount that an entity would currently obtain from disposal of the asset after deducting the estimated costs of disposal if the asset were already of the age and in the condition expected at the end of its useful life. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Carrying amount is the amount at which an asset is recognized after deducting any accumulated depreciation impairment losses. Let's move forward to initial recognition, as all assets have 2 criteria. First, it is probable that future economic benefits associated with the item will flow to the entity, and secondly, the cost of the item can be measured reliably. If both these are met, the asset can be recognized. These criteria apply to subsequent expenditure as well as costs incurred initially. Once recognized as an asset, items should initially be measured at cost. The cost includes the purchase price, less trade discount or rebate, directly attributable costs of bringing the asset to working condition for intended use, and finally initial estimate of the costs of dismantling and removing the item and restoring the site on which it is located. The revised IAS-16 provides additional guidance on directly attributable costs included in the cost of an item of property, plant and equipment. These costs bring the asset to the location and working condition necessary for it to be capable of operating in the manner intended by management, including those costs to test whether the asset is functioning properly, which are determined after deducting the net proceeds from selling any items produced when bringing the asset to its location and condition. Then let's come to final part of the standard, that is the measurement. Subsequent to initial recognition, there are 2 models of subsequent measurement: cost model and revaluation model. Under cost model, assets are carried at cost less depreciation and any accumulated impairment losses. Under revaluation model, assets are carried at revalued amount, that is fair value less subsequent accumulated depreciation and any accumulated impairment losses. The revised IAS-16 makes clear that is available only if the fair value of the item can be measured reliably. Lastly, we have the revaluation rules and depreciation rules. Under revaluation model, revaluation organizations are required to carry out revaluations regularly, depending on volatility. Fair value is usually market value or depreciated replacement cost. If one asset is revalued, so must be the whole of the rest of the class at the same time. Increase in value is credited to a revaluation surplus. Coming down to depreciation rules. It is based in the statement of financial position. It determined for each significant part of an item, like an engine of an aeroplane is a significant part and thus should be separately depreciated. Excess over historical cost depreciation can be transferred to realized earnings through reserves. The residual value and useful life of an asset as well as the depreciation method must be reviewed, at least at each financial year end, rather than periodically as per the previous version of IAS-16. Changes are changes in accounting estimates and are accounted for prospectively as adjustments to future depreciation. Depreciation of an item does not cease when it becomes temporarily idle or is retired from active use and held for disposal.